Hello, this is Claire Dickinson, News Editor for Hedge Funds Review. I'm joined by George Papa-Markakis, Portfolio Manager of the Max-Q Fund and a Founder and Chief Investment Officer at North Asset Management. So George, how would you describe your alpha proposition to investors?
Our alpha proposition is quite similar to most macro funds, but we have a few distinct differences. In terms of the similarities, we're similar in the sense that we have a top-down approach, very much regressing macro fundamentals, macroeconomic data with market data, and seeing whether there's any anomalies, any dislocations which we can take advantage of. I think where we differ, and differ quite substantially from our peer group, is the fact that we focus very much on other markets, meaning your typical macro fund will have a very large exposure to the G3 markets. We will have a quite balanced exposure between G3 and non-G3 with a quite strong focus in the European time zone. The second difference, which is also quite substantial, is I think most macro funds will tend to have an asset allocation model equally weighted between, for example, equities, fixed income, foreign exchange, and try to allocate depending on whether they feel they're in a risk-on or risk-off environment, a growth or a inflationary environment, for example. What we do is we focus very much on two products, fixed income and foreign exchange, and to a lesser extent, a much lesser extent, equities. And a lot of the trades that we do tend to have some type of a optionality embedded, and also we do quite a lot of relative value trades, especially over the last couple of years with what's happened in Europe. And I would say the third difference, which really distinguishes us from our peer group, is the fact that we trade our portfolio quite aggressively. That's both a function of the fact that I think the markets have become a lot more unstable and volatile, but also we think it's a source of pure alpha, because simply the market at certain times gets overextended in positioning, and as a result you have the ability to take advantage of that, because when that position gets overextended, the unwinds potentially don't reflect underlying fundamentals, but you'll get an overshooting of that asset class, which we think is an opportunity to participate in.
You were one of few global macro funds which ended 2011 positive. In fact, you were up over 25%. What factors contributed?
Some of the things that I mentioned before contributed. One is that we had a very, I would say, short-term investment horizon, taking into account the fact that we were in a very volatile trading environment, very volatile policy-making environment. And therefore we didn't get caught out by potential reversals in the market. The second thing is, I think last year we were quite, the markets, I would say, we were quite fortunate because there was a lot of dislocations around the world. So we took advantage of, for example, the slowdown in China. We took advantage of the fact that the Chinese renminbi market started becoming more liberalized, and therefore forwards started to normalize, FX forwards. We took advantage of the weakening in the commodity complex towards the end of Q3, when people again started questioning the spillover from China. And we also took advantage significantly of the opportunities within the European time zone and all the turmoil that we've seen. But I think the key difference, again, between us and potentially our peer group is that we had a much shorter investment horizon. And we also probably had a reasonably diverse set of themes, which, again, we traded with a very short-term horizon.
Mm. And the fund seeks to benefit from market volatility. How does it do that?
Well, there's two reasons for that. One is that we actually tend to have a net long vol position. So we won't indiscriminately buy volatility, because as we've seen in 2009, if you're long vol without taking necessarily into account the absolute level of volatility, of implied volatility, that's not necessarily a good investment proposition. But whenever we find volatility which is low versus a change in the underlying fundamentals, we will purchase that. So for example, the fund as we speak is long Chinese volatility on the Chinese yuan, because obviously we're seeing quite a lot of things happening in China. One is the liberalization of the FX market, which is increasing volatility. Second is the actual policymakers wanted to increase volatility in the spot market. And the third is we're seeing quite a change in the perception of the growth profile of China going forward. So whenever volatility is cheap on a historical basis, we will tend to be long. However, that's one part of the portfolio. The second part of the portfolio is that because we're very trading oriented, we have the ability to shift our positions quite quickly and take advantage of potential unwinds that we're seeing in positioning, which, as I mentioned before, might be overextended. So what we've seen after 2008 is obviously a significant diminishing in bank capital and the ability of banks to warehouse risk. And so I think that creates an opportunity for funds like us, which have the ability to take advantage of that reduced liquidity and the need for investors to get out of positions very quickly, something that we look to take advantage of.
Mm. And you tend to stick to liquid markets. Are you missing opportunities by doing that?
I think we are. That's the short answer. But we have very liquid terms for our investors. We offer 45-day liquidity. So we offer monthly redemptions. And I think it would be imprudent to have the portfolio positioned in illiquid assets when we don't offer those, when we have different terms to our investors. In 2008, we saw a lot of funds which obviously had significant illiquid positions which their investors weren't aware of. In contrast, our fund halved, despite having a very good 2008 and being significantly positive. We had redemptions like the rest of the industry, and we were able to meet them in a very orderly manner without imposing any gates. And that's a function of being invested in those liquid markets. So although we are missing opportunities, I think it's not what we have offered to our investors. The second thing is that I think illiquid strategies really need to be taken into account with the portfolio in its entirety. In other words, it's not only the redemption profile that you have, but how will the rest of your portfolio perform when your illiquid portfolio is not performing. And that is something which I think, although we've done a lot of modeling in the past when we first started the fund, it's very difficult to understand exactly how the risk would change within the portfolio. So sticking to liquid instruments allows us to, I think, manage the portfolio in its entirety in a much better way.
Mm. And how do you define a liquid market, given how they're behaving at the moment?
Well, we have a quite straightforward way of defining it. We would say liquid is anything that you can effectively get out of or liquidate within 24 hours. Anything which takes more than 24 hours becomes more illiquid, and then obviously there's positions which take potentially months. So we stick to products which for all practical purposes you could get out of within 24 hours.
Right. And what is your top-down macro analysis for the next 12 to 18 months?
I think the next 12 to 18 months we'll see much of the same that we've seen in 2011 and first part of 2012, meaning that we're going to see more problems in Europe, and at the same time we're going to see a continued response from European policymakers. I don't think we're going to see any type of total disintegration. There is the very large question mark regarding Greece due to the upcoming elections. But other than Greece, which has always been, I think, a bit of a unique case, I think we're going to see more of the same. In other words, Spain's going to come under pressure, and we're going to have some type of response. I think more and more, especially, we saw that at the end of last year and the beginning of this year, more of the response this time is going to come from the ECB, rather than expecting any type of common Eurobond issuance. I think Europe will continue to be the main theme that will, or the main issue that will dominate financial markets. But at the same time, we have a couple of other issues which I think are very important. One is in the U.S., where I think people have quite a benign view on the outcome of the elections, and more importantly on the outcome of the fiscal tightening. The U.S. is heading for a 5% contraction in terms of the tightening that's 5% of GDP in terms of the tightening that's implied due to the runoff of the tax cuts and also due to the runoff of the unemployment support. So although there will be some type of adjustment from politicians to that, I don't think it will be as benign as the market is expecting. So I think that's another quite substantial hurdle which the market will be facing towards the end of this year, beginning of next. And finally, I think that the third issue, which is very important to take into account, is the change in terms of the composition of Chinese GDP growth. China's clearly made a very large effort to change the composition of growth, become less commodity intensive, and that's something also which I think will affect the commodity complex. So there's quite a lot of things up in the air, but probably in a nutshell, I would say Europe will continue to be the main source of volatility in the markets. And I don't think we're going to get any huge tail event, but I do think we're going to get continued volatility where markets will push policymakers to take action. Policymakers will take that action, but it will be very short-lived. So a continuation of last year, I would say.
And how about your micro bottom-up analysis?
Micro bottom-up analysis, we're spending a lot of time focusing on two things. One is the developments within the commodity complex currencies and whether the demand from China or the perceived slowdown in terms of demand from China will materialize, what type of a knock-on effect it will have on those currencies. And the second thing which we're focusing on is the developments obviously within the European time zone and especially on the issuance calendar. Governments are in the periphery, but even France is having a tough time with its issuance calendar, and that's always a source of opportunity for us.
And you've talked about what you think might happen in the Eurozone. Could you just elaborate a little further and tell me what effect that might have on performance?
Well, one of the sources of return last year was the Eurozone crisis, and we think that will be another source of opportunity, and it's for two reasons. One is that this incredible amount of supply that you're seeing, government bond supply, is having a problem finding a safe home. And as a result, any issuance that comes into the market either comes with a slight or a substantial discount. So the ability to trade the upcoming government bond supply is a source of opportunity. The second thing is that you're also seeing quite, I think, a substantial shift after the French elections in terms of the priorities within Europe. Clearly, France is trying to push towards a more growth and fiscal loosening of the Eurozone in its entirety. It's also pushing for some type of common issuance, which I don't think has any chance of materializing because Germany's not up for it. But all those, or if you like, France pushing with the support of some of the other peripheral countries for a loosening of the fiscal pact, or if you like, adding another growth dimension, does create an opportunity for us in terms of trading the government bonds against each other. So I think in the immediate future, for example, French bonds will underperform because people will question the commitment by the new administration to tightening, and at the same time, issuance continue to come into the market. So the ability for the market to digest that incredible amount of supply is quite limited. The other thing is that France continues to be exceptionally exposed to the periphery, much more than Germany. So although Germany is a larger lender and the banking sector is quite substantially exposed, the real economy of Germany is less exposed to the periphery compared to France. So the French growth rates will continue to underperform Germany, and again, that will be another source of market volatility. And of course, Spain continues to have its problems. And the real issue, which again, I think there will be some type of response from the ECB, and therefore you always have to keep that short trading environment or very short-term trading style that I mentioned before, is Spain, which continues to have a tough time dealing with these exceptionally high real rates. So what you need to get, which I think policymakers recognize, is you need to get credit intermediation working again in the periphery. And the second thing is you need to have negative real rates across all of the Eurozone and not just in the northern European countries. So both of those issues, I think, will be addressed by the ECB effectively taking some type of action, but only when things get worse. So you have to wait for things to get worse and then expect some type of a snapback. And we're going to see that, I think, at least a couple of times this year.
How bad do you think things might get before the ECB takes action?
I think we've seen the ECB take action when yields in Spanish and Italian bonds have been roughly around 7%. And so we're pretty close to that. I don't if we don't get any immediate relief from the upcoming EU summit, which I don't think we will, probably the markets will turn a little bit, will become a little bit weaker, and then the ECB will try to think of something. I'm not sure whether it's going to be post or pre the Greek election, which is another catalyst for the markets, but I think we're pretty close.
And how are you hedging the portfolio?
We hedge the portfolio by having, I would say, a long volatility position, so that always allows us to, that performs usually well in times of distress. The second thing that we do is we focus a lot on, as I mentioned before, our micro opportunities. We try to take out the overall risk exposure to the G3 world. So, for example, like I mentioned before, a lot of the trades that we do are outside of the Eurozone, which, however, are affected by what's happening in the Eurozone. So, for example, one position that we believe strongly in is that Czech rates, so rates in the Czech Republic, will underperform substantially, but mainly versus Europe. So we'll trade one currency or one interest rate market versus another market. And that's usually the predominant theme or predominant hedge we will use in order to isolate overall global risk environment and focus very much on that micro opportunity.
And what are the greatest risks to performance at the moment?
For our fund, the greatest risk is if we become in a very low volatility environment, and that potentially could take place, I think, if we get an extreme amount of policy activism across the world. So similar to what we saw in 2009, where we saw a very big reflation trade. That would be difficult for us to manage because we like these markets which are choppy and volatile. So if we get one very big trending environment, I think that will be a little bit more difficult for us to manage.
Where are the opportunities this year, in which sectors and which geographies?
So Europe will continue to be a source of potential return because of the volatility that we're seeing due to the crisis. And that will be predominantly focused in the fixed income space. We don't think actually the euro as a currency will trade necessarily one way or the other to a large magnitude. I think the big source will be what's going to happen with French bonds, what's going to happen with Spanish bonds, how is all the issuance that's going to come to the market be taken down in an orderly fashion, and what is the ECB going to do in terms of reacting to the deteriorating growth environment. So that will continue to be a source of opportunity. Outside of the Eurozone, but within the European time zone, I would say there is a big differentiation in certain markets. So for example, Switzerland's a very interesting market because interest rates there in the front end are negative, which we think you can trade both on an absolute but also on a relative value basis. There's opportunities in Norway and Sweden as well because Norway, to a certain extent, is a large beneficiary of what's happening in Europe, seeing a lot of portfolio flows into Norway. And against that, it's actually seeing quite a strong growth environment, both due to the oil price being quite high, but also because the domestic economy is actually performing quite well. So there's a bit of inconsistency there in terms of monetary policy versus actually underlying fundamentals. Outside of the European time zone, I think there's interesting opportunities in the commodity complex. So for example, there's certain currencies like the Brazilian real and the Mexican peso, which have underperformed substantially versus the Aussie dollar, the Kiwi dollar, and that doesn't, or definitely I don't think reflects underlying fundamentals. For example, Mexico I think is one of the cheapest currencies in the world. It depreciated substantially in 2008 and 9 on the back of the financial crisis and really never got back to where it was before. And it's actually gained substantially in terms of competitiveness versus Asia and China specifically. So that's another currency that we like. And finally, I think again in the emerging market space, interest rates, for example, in Turkey, I think will reprice higher. So there's a few themes out there, and I think the main theme is actually always being quite opportunistic and having a quite short-term trading environment. One thing to bear in mind, especially with macro trading, is that, and especially the way we implement our strategies, is we always want to be in a position where we can take advantage of unforeseen volatility. Timing is the most difficult thing in our field, and therefore the best way to deal with that is to always make sure you have enough capital on the side to be able to deploy it in times of crisis.
George, thank you. And thank you for watching. This is Claire Dickinson for Hedge Funds Review.